Good morning and welcome to today's Moss Adams webcast, SEC Material Weakness Trends and Remediation Strategies. Before we begin, I'm going to start a brief housekeeping video.
Welcome and thanks for joining us. Moss Adams webcasts are designed to help elevate your business performance. Transform your future for the better with advisory solutions tailored to your vision and supported by our collective technical resources. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget. You can ask our presenter questions during the webcast by typing a question in the Q&A window and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% or 3 of the 4 polling questions, which we'll ask throughout today's presentation. Polling questions will appear within the slide window. To participate in the polls, please click on your answer and be sure to hit the Submit button to record your response. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry, if you can't download your CPE certificate today, we'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our group CPE attendance sheet to receive credit. The attendance sheet is available in our slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit only can be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And before we get started, I wanted to acknowledge our recent news that Moss Adams is joining forces with Baker Tilly to create a new firm, one designed to serve the needs of the middle market. It's really exciting, and you can read more about it on our website via the link posted in the slide deck and handouts widget to the right of the slide view. And with that, Findley, I'll turn it over to you to get us started.
Well, thank you so much. My name is Findley Gillespie. I'm a partner in our Risk Advisory and Compliance Group, and as well as a partner in our SEC audit practice. And so as part of this, what I'd like to do is share a little bit about our backgrounds, and then we'll dive into agenda, and then from there go through our presentation today. So again, Moss Adams as a firm works with a lot of public companies, both on the audit and the advisory side. I started my practice some 20 plus years ago on the assurance side of things, and then moved over to advisory starting in 2004. And as part of that, spent a lot of my time working with companies that are looking to go public or are public. And so as part of that, we've seen a lot of this, and certainly over the last couple of years, starting 2020, kind of that run-up of IPOs, much of it fueled by SPACs, and then the corresponding results of that in terms of material weaknesses. And so today we are excited to present on both the trends we're seeing in material weaknesses, as well as ways to actually remediate those. So whether you're public or whether you're private, looking to go public, all of those categories, this will be a webinar that should speak to you. So again, thank you so much. I am actually based in the Washington area and as part of Washington State, and as part of this tied to the national office here, and that's where I sit. So anyways, thank you so much for joining us today. I'll turn it over to Erin to give her background and then lead us through our agenda.
Great. Good morning. My name is Erin Clayville. I am a partner in our risk advisory practice as well. I sit in the Pacific Northwest. I've got almost 20 years of experience, both in Big Four, in industry, with both public and private companies, and I've been at Moss Adams since 2011, really serving companies that are kind of going through that growth projection or growth phase and looking to go public, already a mature public company, but but really kind of focused in that space, and excited to be here today to talk about everyone's favorite topic, material weaknesses. So basically what we plan to cover today is just an overview of what is a material weakness, some recent trends, and we've got some great data to share with you in the first half of the presentation, and then talk through some vulnerabilities that could lead to a material weakness, and also how then to remediate a material weakness. So just so we all are level set here, a material weakness is a deficiency or combination of deficiencies in an organization's internal control over financial reporting, or ICFR, that creates a reasonable possibility that a material misstatement in the financial statements would not be prevented or detected timely. So for SEC registrants, material weaknesses are required to be disclosed publicly in their Form 10K and their Form 10Q for investors and the whole world to see. So in some cases, a disclosure of the material weakness, or MW, you might hear me say today, can occur even before companies are listed or subject to Section 404 of the SOX Act. So we'll get into that a little bit later, but wanted to make sure we all understood what we were talking about today. And just thinking about the potential impacts of a material weakness, so these really can be far-reaching. Material weakness may signal a risk of potential inaccuracies within the financial statements that could lead to a loss of investor confidence. Some of the regulatory bodies, such as the SEC or the PCAOB, may increase oversight. There may be negative market reactions that lead to stock price fluctuations. And internal and external audit costs might also increase as a result of additional testing needs. We often see that the external auditors will increase the substantive audit sample sizes as a result of a material weakness. So not only is it a significant cost increase, but then there is also the related impact on the accounting and finance teams just to be able to resource those increased audit requests. And then lastly, the remediation of material weaknesses will likely create disruption within the organization, and depending on the breadth and the depth of the material weakness, it may require quite a significant allocation of resources, including time and dollars.
All right.
Looks like we have a polling question, Emily.
Yep. Our first polling question of the day: which of the following may result from reporting a material weakness in your financial reporting? And your options are A, loss of investor confidence; B, increased regulatory scrutiny; C, operational disruptions; or D, all of the above. And I'll give everyone a few moments to respond. To participate in our polls, please click your option and make sure to hit that submit button. And if you're having any difficulty seeing the polls, you may try refreshing your browser. So we'll give everyone just a couple more seconds on our first poll here. All right, let's go ahead and take a look at the results. Back to you.
All right, looks like you're paying attention. All of the above is correct. So we're gonna keep moving into our trends and data reporting here. So just a quick plug that we pulled all of our data from Edgar. We've pulled the data through April 21st of 2025 to capture all filing dates through December 31st, 2024. So this is fresh data, and it actually may not include all filers, as I think the website is still publishing updated information. So there will be a final report published in mid-June, so for early access here. The first few slides in our deck are going to give a quick overview of all of the data that we've collected. And I guess just as a refresher, SOX has two requirements, or SOX 404 has two requirements: SOX 404A, which requires management to assess the company's internal controls over financial reporting, and then SOX 404B, which requires the registered public accountant to attest to management's report over internal controls. And then we also have, well, the data we pulled is going to be based on filer status. And so all filers are required to maintain and have management assessment on ICFR. And the majority of large accelerated and accelerated filers are also going to require that auditor attestation. There are exclusions, so smaller reporting companies or emerging growth companies which may not have to report on ICFR. So our data looked at companies that filed from 2020 through 2024. We collected over 5,000 reports that have just the management only assessment and over 3,000 reports that have the external auditor assessments. So each of our results slides are going to include both a bar chart and a line chart. So we've got a couple of different slides for each. But you'll see here the bar chart that has the total combined assessments with both management only and the external auditor assessments broken out by adverse and or not adverse. So any of the adverse assessments are going to represent an assessment with an internal control deficiency or a material weakness. And so just kind of at first blush, you'll notice that there was a pretty significant increase in material weaknesses reported in 21 and 22. And then we start to see a decline in 23 and 24. And so I'll flip to the next slide and kind of break that down. I think in 2021 and 2022, we had an all-time high of over 1,800 filers, nearly 26% of filers in 21 and then in 2022. And I think that this can partially or maybe substantially be attributable to the SPAC boom during that period. There were quite a number of companies in 2020 and 2021 that were going public through a SPAC, and a lot of them did result in material weaknesses. And then we start to see a decline in that adverse disclosure rate in FY23. It dropped from 26 to just under 24%, and even greater decline to just over 15% in 2024. So it's a good trend, I think, for a lot of companies. So this chart's going to show the ICFR auditor attestation only, so our accelerated and large accelerated filers. And I want to highlight actually on the line chart that the adverse attestation for the accelerated and large accelerated filers was nearly identical in FY22 and 23 at about 8.4%. Again, likely related to the SPAC boom. And now we're starting to see that decline. So this slide is then going to show the management only report. So our non-accelerated filers that don't have that auditor attestation. And you can see that there's a significantly higher adverse attestation rate, despite the fact that the auditor is not evaluating controls for these companies. So this would be driven primarily by audit adjustments or errors in financial statement audit that would result in a corresponding internal control deficiency or material weakness. And if you look at the bar chart, you can see that it kind of trends in the 40th percentile the last few years, but is now finally starting to decline. And I think this also can be attributed to some of those first-time filers in 21 and 22 and the SPACs that really went out quickly without a lot of time to stand up those accounting teams prior to becoming a public company. And then this slide, I think, is a great slide. I just want to highlight that it's worth noting that the consistently high percentage here of repeat adverse reports. In general, over 60% of adverse assessments are repeat filers and nearly 70% in the last 2 years. It's a pretty high number, but I think it's not really surprising just given the effort required to remediate material weakness. I'm going to turn it over to you now, Findley.
Great. Well, thanks, Erin. I am seeing just a question in the chat, so feel free to put those in there as they come up. One of the questions that somebody asked is just, does this apply also to foreign filers? And so let me just pause, and then we'll jump back into the presentation. It most certainly does. So again, depending on your status as a foreign filer and what actual filings you are required to file with the SEC. So in most cases, it's your foreign filer, you're called an FPI, foreign private issuer, and then as part of that, ultimately, then you are required to file at least an annual report with the SEC. SOX does apply, but then just more broadly, the concept of material weaknesses does apply to all companies, would be public, private, U.S., international, et cetera. And so the content that we're going through today does describe what that looks like in terms of what the stats are for companies that filed at year end 12/31, 2025. But then it also would apply to companies that are foreign filers, companies that are not listed on the U.S. exchange, kind of the concepts in here, obviously not the data contained in the data set, but again, that is something that applies. There are some different thresholds. Certainly, as you look to that, it also applies. There are some companies that are required to file because they have public debt, but no public equity, and they're considered a quote voluntary filer with the SEC. As part of that, they're also required to file Ks and Qs, and as part of that, while they have to file Ks and Qs, they have no public float. So obviously, that's one of those factors as you consider what SOX 404A or B is required. And so again, there's a couple of thresholds there, both based on revenue, based on debt raised, and based on public float. So again, there's a whole variety of those things, and we can, please, if you have questions, please ask us later. We can address that separately or offline. Please consult with your SEC legal counsel. They'd be glad to give some answers there. So again, it does apply, and the concepts, even if you're not public today, trying to understand what are the common material weaknesses and what can you do about it, will be helpful today. So just wanted to hit that question real quickly, as some of you turned in and had some questions. So jumping right into the actual internal control issues that were identified through our review of Edgar specifically. Here's what they are. You can see the top 5 here, and accounting personnel, which usually is a lack of personnel, and it could be just the sheer number. It could also then be subject matter experts in a specific technical area. It could also be because the team is so small, it doesn't have proper segregation of duties, which is actually number 2. And so those things kind of go hand in hand. Information technology, we'll get into that a little bit more detail later. But one of the IT related items. The 4th one, inadequate disclosure controls, which again we'll get into, and then non-routine transactions. That final one of non-routine transactions is a very common area. When you think about it, you've largely built your companies to do the routine items. And so when something unusual occurs, that's an area of common material weakness. So we're going to just get into this in a couple slides. We'll move quickly through these, but just as you think about just kind of where these are, you can see the inadequate personnel, that's that top gray line. That is by far and away more than any of the other ones, right? So as you think about what that looks like, if you pair the first 2 of inadequate personnel and segregation of duties, that's a huge percentage of what these things look like. Obviously, you can have multiple material weaknesses, or this would add up exactly to 100%, right? But those first 2 a lot of times are paired very commonly. So again, just something to think about. As we get into the actual auditor adverse opinions and then what those issues were, it's the same things. The percentages are a little bit different. And if you think about it, public companies that are going through an audit of SOX, or what's called the integrated audit, those are going to be your larger, more sophisticated clients. So you'd expect that they'd have, in many cases, more personnel. And so, you see that drop down just a little bit, and you see segregation of duties drop further down the row. At that same time, because it's a larger company, they tend to have more complex IT environments. A lot of times they'll have multi-locations, multinational companies, et cetera. And so the IT becomes an increasingly important area. And you can see what that looks like. One of the things I want to do and pause on this one is actually just talk towards the trend line here. And what you can see is, while accounting personnel, I just said it's less of an issue than it was for all filers. So if you think about those that have an SEC or have an audit of SOX, i.e. 404B or an integrated audit, what you can see is that trend line, accounting personnel continues to ramp up. And I think, again, that comes back to both the number of folks that are on the team, as well as then just their specific skill sets. So that's one of those things that we also see when companies usually have a material weakness. It's a combination of a failure in underlying process, accompanied with something on the people side as well. So, whether the process or the IT coupled with personnel, because again, a lot of the controls that companies have are going to be detective type controls that are people reliant, are people dependent, or a person's actually performing that control, and a lot of times that review control. Obviously, the goal here is to move towards more automated controls in that IT area. But if you don't have strong IT controls, then you're really stuck with that. So again, just a couple highlights as we think about what this looks like. What I also want to do is just look at what management said. And again, same chart as before. This is where just management has done their opinion. So it's a 404A company. And so as part of this is you can see the similar type things, again, personnel, segregation of duties, and then gets into the other areas. I know a number of you are asking, okay, well, that's great, but what are kind of the actual core issues? And so what we'll do is actually speak towards that. So here's the actual types of accounting issues that are captured in those material weaknesses. And in some cases, it's a very, very broad material weakness. And so it's difficult to understand what that looks like. And again, that comes back to a lot of times inadequate personnel, IT, et cetera. But when we think about just the accounting related issues that are contained in those assessments, here's what they are: RevRec, inventory, AR, taxes, fixed assets, intangibles, et cetera. So again, thinking about what those things look like, and I'll put that on just this next graph that shows kind of what those percentages are over time from 2020 through now. So that 5-year window, we see obviously that huge peak in green there in 2021 for debt and warrants. That was related to all the debt related or all the warrant related issues that came through as part of the SPACs in 2021, where the SEC said, hey, you're not accounting for this correctly. So that led to a whole slew of both restatements as well as material weaknesses. And those things typically go hand in hand. In almost all cases, if you're going to have a restatement, there's a control failure. The question is where and when was that control failure? So that's why we see that peak in 2021. But if you were to strike out that just abnormality there, what you're seeing is a lot of these things are consistent year over year. And specifically, as you think about it, RevRec is that top line as we get to 2024. It's that light blue line. It's the top one from 2020 all the way through. Now, I know a lot of you are saying, boy, we adopted 606 years ago. How is that still an issue? Well, that's, since I started my career in the 90s and have been doing this for 25 years now, is part of this is RevRec has always been a critical area. It's a critical area for your auditors, critical area for the SEC, critical area for your investors, customers, et cetera. And so again, that's one of those areas that's just of utmost importance as we think about what that looks like. So I know a lot of folks are going, wow, we did 606, we're done. Well, as noticed here is it's about 9% of all material weaknesses relate back to RevRec, and that's in a post 606 environment. So again, something to just consider as you go through this is make sure you have good sound controls over revenue. All right, as we think about just what the auditors have cited as issues, here's the list. We're in a 404B situation where the auditors have cited things. And again, I want to point out on the prior slide, that was 9% for RevRec. This is 23. So again, as we think about what that looks like, this is a huge number that are tied to RevRec, which is that light blue line in the very top piece of this. Obviously, because these are 404B or auditor assessments, we're not seeing that big spike in the debts and warrants and all those issues from the SPACs, because that's not an issue because these companies didn't do that. That was unique to the SPACs and a pretty common issue that folks had in 2020, 2021. So again, we don't see that spike in here, but again, this just goes to amplify what we're seeing here in the data, which is RevRec is towards the top, or is the top one. Obviously, we see inventory spiking up since 2022, so it's rapidly catching RevRec, and you can see that in 2024. But again, just be thinking about some of those things. I know in my client base, there's a lot of issues around inventory. I feel like 2024 was the year of inventory. People had a lot of challenges there with systems, with costing, with a whole variety of things. And certainly if you think about some of the supply chain costing elements and supply chain challenges that have occurred from COVID forward, from kind of 2021 forward, a lot of that, as you get those flush through your inventory or your standard costing type systems, those are going to take some time to kind of pop up and show their ugly heads. But again, that's something that we're seeing a lot of issues there as we think about what it looks like. So that's that. I'm sure some of you are going, boy, what do we have for controls there? And so I'd encourage you to go think about those things. This is the management only report. So again, the way we've been presenting this is all filers, then filers that actually go through an auditor attestation or audit of SOX or internal controls. So a SOX audit, 404B or integrated audit, and now just the management only. You see the management actually doesn't have RevRec towards the top. And again, that was led by, in the prior two slides, the prior two charts, that was by both all filers and then the auditors. So again, you can see that the things are a little bit different by grouping and what that looks like. But again, I want to encourage you to think about what those top 5 things would be and how that impacts your controls. So again, another consideration to have. And we can see here on the chart, again, because these are non-audited SOX clients or companies, you did see that huge spike in 2021 for the debt warrant issue, which the SEC came and said, hey, you're doing it wrong. And frankly, nearly everybody who's accounting for it said, oh, shoot, we got to restate. So again, common issue that popped up through that, but it's kind of a one-off pop there. All right, so the other piece is we're talking about just the different size of companies and what they have to do, when, et cetera. Really it's driven on the size of companies. So this does not include EGC or emerging growth companies on the slide. Instead, we've just got large accelerated, and non-accelerated. And as part of that, we can see what kind of that failure rate is by grouping. And I guess from my perspective, this is not surprising. As you think about the biggest companies, they scored the best on the bottom side here. Then you look at the next tier, the accelerated, they score a little worse. And then the non-accelerated, which is the smallest of the companies, they score the worst as we think about what that looks like. So again, this is the percentage of adverse ICFR, internal control over financial reporting, findings in the 10Ks. As part of that, you can see for non-accelerated filers, it's actually positive. It's coming down, as is accelerated filers. Large accelerators have been pretty consistent. And this is where you think about some of the really large companies versus kind of mid-cap, small cap, and what that looks like. I'd also say a lot of, because of the emerging growth company opportunity, EGC, that came through the Jobs Act, that actually gives some reprieve for some companies that may even be accelerated, until their 5-year status expires as an EGC company. So again, there's some of that way, and the design behind that is to give companies some time to catch up and actually be ready to be full public companies. So again, the Jobs Act was jumpstart our businesses. And so the idea is to allow them an on-ramp, as was called out in the legislature. So again, it's an opportunity for them to scale into this and to really lead in. But as we see that, what we're seeing is because of some of these companies, and if you think about some of the results we had related to personnel, segregation of duties, et cetera, that's because they're small. They're just trying to go public, and that's what that looks like. So again, something to just consider based on where you are. And certainly as you flip from 404A, or even before 404A into 404B, realize that there's going to be increasing pressure, and obviously you're going to have to go through a full audit of that. All right, so as we think about this, here's large accelerated filers. I said it was largely flat, right? So this chart is really only between, relevantly between 4 and 6%. So that's a real small percentage, but we can see even at the accelerated filers, and this is why we wanted to zoom in on this, is we can see that we're seeing some drop off since the high water mark of 2022. So again, it's something where we're looking at this going, okay, what does this look like in terms of adverse disclosures? And you can see, the high water mark, like I said, in 2022, and then dropping off over the last 2 years. So that's positive news as we think about that. And again, this is independent of what's going on with both PCAOB and the SEC, what the auditors are being tasked with. This is just the pure results. And obviously, there's been a lot of scrutiny by both the PCAOB and SEC. Obviously, the part of the SEC, PCAOB's role is in question under the current administration, but as part of this, there's a ton of scrutiny from the PCAOB of its auditors, and then that translates to what companies are reporting. So again, just wanted to zoom in. It's not flat, totally flat as is shown on the prior slide. So we wanted to really show that. As we think about accelerated filers, again, just thinking about what this looks like is another opportunity, kind of another view here. And so again, similar to the large accelerated filers, large accelerators peaked in 2022, accelerated peaked in 2023. So again, another view towards what that looks like, but it is positive that it is coming back down. So again, these are in those reports, and because they're accelerated filers, they actually end under 404B, which is the integrated audit or audit of ICFR. So again, we're seeing that similar trend line, which is very, very positive. Unfortunately, it's not back to where it was in kind of the 2020, 2021 timeframe, but we're seeing that trend line come down. Hopefully, as we get into 25 and beyond, it continues to go down. All right, this is where things get a little bit interesting and a little bit choppy here as we think about what this looks like. And obviously, as Erin shared up front, was pulled off of Edgar data. And as part of that, some of the non-accelerated filers hadn't yet filed by the time we were able to pull this information. Obviously, everything was due. Not all of them had it in. And then also we used a third-party tool to pull this, so a little processing time in there. But if you look at just the percentages instead of just the aggregate number, If you look at the percentages and see what that looks like, you go, wow, what does that mean? And specifically, as we look at that green line, again, we're seeing a lot of issues in the non-accelerated piece. This year, I'd imagine that 2024 that dropped off so considerably, I would imagine that that'll pop back up once we get all the filer data in for non-accelerated filers. But again, it's one of those things where there's a lot of issues here. 2022 obviously being a peak in the adverse management reports. So again, it's one of those things of what that looks like. That's the high water mark in terms of absolutes, high water in terms of percentages in 2021. And again, that's tied to all of the SPAC or companies that went public quickly in that kind of 2020, 2021 timeframe. And I do want to pause, and Erin mentioned this earlier, is you can have a material weakness even before you're subject to 404. So you can be a private company with a material weakness. You can be a company that has filed an S1 or registration statement, but has not yet gone public and still have a material weakness. So as we think about what this looks like, you can have those things in advance of actually being a public company, in advance of being subject to 404, either A or B. So that's how you can get some of this, and that's why we have that high watermark in 2021. It's that quick run up of companies both in 2020 and in 2021 of going public. So again, a lot of those things really exposed themselves as the company started getting into filings, both Ks and Qs, of what that all looked like. All right, well, we've talked a lot about SPACs, and again, this is a hard slide to interpret, but we'll try our best here as we think about what SPACs did. Obviously, you can see what this all looks like in total numbers if you add both colors together in the bar chart. But as you think about it, okay, there's very few in 2020, and then just like gangbusters took off second half of 2020. Kind of that post COVID time when COVID had just started, kind of that fall of 2020. And then you see in 2021, 2022, there's a lot of them. Now, two things I want to point out is the adverse is the dark bar, the dark green, and not adverse is the light green. So you can see in 2021, the reason why that's so high as a percentage, not in terms of absolute numbers, the 300 something, but in terms of the percentage, that's a lot of that's tied back to some of the debt option warrant issue that was done in 2021, where basically every company that accounted for these, the SEC said, hey, you're doing it wrong. And so again, that resulted in a huge slew of restatements. And then, but what you saw is you see that adverse number comes way down in 2022. So if we were to strip out, we actually did this separately, if we were to strip out some of that debt warrant issue that we talked about, the classification of those, it comes way down. And you can see that here just in the data. And so while even though the number of SPAC ICFR reports had its peak in 2022, obviously they were looking, as a sponsor, looking for a target company, and then that's decreased. So the aggregate number of 400 and something in 2022 went down by nearly half as companies consummated a deal with an operating company. See that go way, way down. You also see the adverse piece of that come down. So again, it's one of those things, though, that those SPACs went public so quickly. They were relatively simple in terms of what they did, aside from this debt warrant liability issue. And then from that, what you can see is them actually buy a private company, in most cases, in nearly all cases, buy a private company, operating company, then spin it up as a public company. And then this is what the corresponding results are. So again, it's one of those things where a lot of those targets, when they try to consummate a deal, were not ready to go public. So again, that's why we see that in the non-accelerated filer data. Also, I'd say this part of this is those companies weren't really ready to go and be a public company, but they also get some of the air cover of being an emerging growth company in nearly all cases. So again, that's one of those things that it took a little bit to kind of work its way through and see what that looks like, because the auditors didn't have to do their 404B audit, only management did. So again, just another data point as we think about what this all looked like. All right, so here it is in just absolute percentage of those SPAC pieces, and we see in 2021 that 83%, and you go, woo, wow, that's scary. But we can kind of strip some of that piece out, and if we just look from 2022 through now, we're somewhere in the 34 to 60% adverse rate for internal controls on SPACs. Again, it's not a great record, and as we think about the difference, the huge difference it is between that and, say, a large accelerated filer, which are the largest filers in the United States and on U.S. exchanges, such a huge difference in terms of what that looks like. And it's, again, because the SPACs didn't have people, they didn't have systems, then they turned around and bought a company that wasn't ready to be public. So again, it's a really quick spin up to being a public company. In most cases, they weren't ready. If you think about some of those common reasons or the common things that actually were cited as material weaknesses: people, segregation duties, systems. Those are the types of things that we see consistently through the SPACs. And then right after they consummate a deal and bring a private company public, those are the same thing. So again, thinking about what that looks like is you're going through your path. So if you're not public yet, or maybe you're SPAC looking for a target, again, just be thinking about these things and the impact of what that means for you. All right, so the other thing we wanted to slice this for is also just by industry. And you can see that the finance has got the lowest of rates for 2024. And you think about some of this is some of those things that they're tied to a regulatory impact or the regulatory component. Them and energy have much lower than some of the other companies. As you think about manufacturing, trade services, tech, et cetera. So again, thinking about what that looks like, it does vary quite a bit. One of the things, with finance companies, there's both an element of how many are small and new public companies, but then also what kind of regulatory requirements are they under, and how does that align with what you have to do for SOX? So again, SOX is purely over internal control over financial reporting, doesn't get into operational metrics, doesn't get into compliance aspects. It's purely on the impact for financial reporting, i.e. are the Ks and Qs accurate? So again, that's where that's focused. But again, some of the rigor that, say, a finance company would have. So as an example, finance also includes banks, thrifts, credit unions, all those kinds of things. But as part of that, they have a much more stringent regulatory environment on a lot of this in terms of their reporting. And in some cases, they have to do near public reporting, even as a private company. So again, thinking about what that looks like. We haven't talked too much about crypto. Obviously, you see that third from the right. Crypto has obviously been a very challenging space for just the accounting, ignoring all the other pieces of pricing and what does that look like. But in terms of crypto, we can see that has a pretty low percentage right now for 2024. If we're to zoom back, that did have some challenges back in the earlier years in 21, 22. Certainly as you think about just the value of these things and how does that work, and specifically, how do you actually have either the manpower or the technology to be able to price those? So again, just a couple thoughts as we think about by industry. So I'd encourage you throughout this course of this presentation is to actually be focused on how this impacts you and your business and your future plans. So again, trying to align with what size are you? Have you been a public company? Are you a public company? What size of public company are you? Are you planning to go public? Industry and those other areas, as well as then some of those specific things that we called out, the types of material weaknesses. I know a lot of people go, tax can't ever be a material weakness. Well, it's usually in the top 5, definitely in the top 10, in almost every year since SOX came out in 2004 for the first public companies. So again, just be thinking about some of those things, because I know a lot of folks go, that couldn't be an issue for us. We're in a full loss position. You have a valuation allowance, et cetera. And well, surprise, you can still have that as an issue, just given the materiality and the disclosure. So again, the PCAOB treats the footnotes the same as the financials with respect to materiality, and as part of that looks through and says, okay, we need to make sure that you've got good sound controls over that, even if you're essentially hidden behind that full valuation allowance. So again, that's something to just consider, is look through some of this data and consider how it applies to you. All right, with that said, that's it on the show and tell chart aspect of this. But what we want to focus now is, what does this all mean to you? So let's just jump into a couple things. So here's some things, as I said, and again, be considering how this plays out for you, specifically your company and those that you're working for. So thinking about kind of those vulnerabilities that could lead to material weakness, we've named a lot of these in terms of the types of accounting issues. We haven't said what kind of the cause is. And we've labeled them here as vulnerabilities, those things that could cause a material weakness. So one of those is high volume of deficiencies. You go, boy, we don't have any big things, but we got a whole bunch of small things. That kind of noise in a control environment can frequently cause a material weakness. And this is one of those things where it's kind of that building, if you will. You don't have quite enough people. You don't have people have strong technical expertise in a specific matter that's important to you, say RevRec. You don't have a system that then supports it. You don't have, as part of that, you don't have segregation of duties. You may not have the controls over significant unusual transactions. Pretty soon it starts snowballing. And so again, you might have a series of of individual deficiencies that aggregate. And that's one of the things that both management and its auditors have to evaluate when they look at deficiencies. So that's one. Personnel, we've harped on that enough. We won't say that anymore. The third one is that insufficient management review. So many companies have great processes leading up to a management review, but when they get to that management review, it's not documented sufficiently. And obviously there's been some challenges in the last handful of years, let's call it 5 years, between 2020 and now, that really around what's required from management to actually evidence their review. So again, there's some pieces there. We've called them hot buttons or focus areas from our friends, both the auditors and the PCOB, in terms of how to handle that. That's the third thing. Fourth thing, technology or management of the technology. Obviously, technology is increasingly important, and all the filers, U.S. filers that are contained in this data. So as we think about that, the pace of controls has to keep up with that technology. Segregation duties, we've talked about quite a bit. Ineffective risk assessment. This is one of those things where sometimes folks will be surprised that something is in scope or that could have a material misstatement. And again, material weakness are based on and Erin just shared the definition earlier, based on what could have a material weakness. So again, as you think about what that risk assessment is if you were to acquire a company, if operations were to change, either for the positive or for the negative, right? So size there were to change drastically, you could have a change in materiality, change in scope, whether it be location, system, et cetera. And again, that risk assessment, making sure you've got a good sound basis for your conclusion at year end is just critical. And then the last thing is regulatory scrutiny. As I mentioned already, there's a whole bunch of scrutiny tied to management review controls, or MRCs as they're called, but then also tied to the use of spreadsheets, key reports, sometimes called IPE, information produced by the entity, or IUC, information used in the control. But again, those concepts of what's required, that regulatory scrutiny is really hammered on some of those things of management review controls, reports and spreadsheets, and those types of things as we think about it. Also is tied to that is also some of the things unique to IT. So application controls are what's called ITACs, which is Information Technology Application Control, or ITAC, ITAC. That's another area that has a lot of scrutiny. And I know in the past, in starting out my career both on audit and then moving on to consulting, helping the first filers comply with SOX, is we didn't dive nearly as deep into IT as we do now. And now, it's kind of the first foray was understanding what the IT general controls were. And I'd say over the last 5 years, the real emphasis has been over ITACs as well as application controls or automated controls. You can think about it that way. Or then secondly is then also thinking about reports. And so those reports and ITACs have been critically important for the last 5 years. And so that's where a lot of companies get hit. So again, it's an opportunity for you to improve and certainly vulnerability that could lead to that material weakness. So with that said, I'm going to get to the next polling question. I'll flip that over to Emily. Emily?
All right, thank you. This is our second polling question. Are you aware of vulnerabilities within your own organization that may lead to a material weakness? And your options are yes or no. As a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. And we are on our second polling questions. We have 2 more coming up after this. I'll give everyone a few more seconds here. All right, let's take a look at the results. Back to you.
All right, so thank you all for paying attention and going through this with me. As part of that, I shared a bunch of things. I see that, about half of you say, hey, yes, we've got some, and then half of them said no. So, 46 to 53. But again, I would just encourage you, even after this presentation, is just to be thinking about some of the analysis that's in here, some of the data, and go, where are we vulnerable? So for those of you who said yes, it sounds like you've already found things and go, oh, shoot, we got to work on those. And those that said no, I would just make sure that you keep this top of mind in terms of what this looks like. We will, as we flip to the following slides, actually get into some more details on what you can actually do about this. And then we will have some time for Q&A at the end of this. And then if we don't get to some of the Q&A questions, don't get to your specific question, we will be able to follow up with you separately. So what that said is, thinking about through the vulnerabilities I just mentioned, kind of here's the response and answer to work on some of those things. So again, as you're thinking about the vulnerabilities, create accountability, ownership, education. We do training for our clients multiple times a year, every single year, because things are changing. SOX is fluid, and what the regulators and its auditors then require is very, very different. So again, it comes back to risk assessment and these things. We'll let you read this and you know, on your own, obviously. But as part of that is I'd really just focus on those pieces. All right, as we go into this next section of remediating material weakness, I'll have Erin speak to that. We'll actually talk about what happens if you're in a spot where you have material weakness. Erin?
All right, so now you have a material weakness. I'm assuming that if you're on this presentation, you at least know what a material weakness is, and that the next part of this presentation is probably more of a refresher for you, but basically just want to outline kind of the key things to think about when you start going down this path. And I think the biggest thing is really just that you need to have a plan, and you'll hear me say that over and over. You need to have a plan. And you need to be aligned with your external auditor. You need to monitor that plan, and you need to do your own assessment as soon as information becomes available. Sometimes when you remediate, it isn't quite there, and it's really nice to have that information as soon as possible so that you can then regroup and make any additional adjustments you need to make. So I will dive into kind of the details here, but I think we have one more polling question. So Emily, that's you.
All right, our third polling question: has your organization reported a material weakness? And your options are yes or no. So for those of you that would like a copy of today's slide deck, you can download them from the folder that says slide deck and handouts. We'll also be sending the slides via email after the webcast. So we'll give everyone a few seconds to think on this. All right, let's go ahead and see what everyone has to say. Back to you, Erin.
All right. Cool. Well, the majority of us do not have not reported a material weakness, which is great. It's not a fun position to be in. I see that some of you have reported a material weakness, and hopefully you're already through it. But if you're not, the rest of the presentation will be very relevant to you. All right, so you need a remediation plan. You need to start as soon as possible. Ideally, what you have done in the 10K is that you've got the material weakness there and a corresponding remediation action plan in the same filing. And so as part of that, you know, the first step would really be getting a detailed understanding of the relevant facts and circumstances, including the root cause of the deficiency. If you don't understand the root cause, you're kind of dead in the water. And so really making sure you understand what's driving that deficiency so that you can really be pointed in that remediation plan. You'll want to develop a timeline. You'll want to make sure that you're including ownership and due dates in that timeline, and a detailed project roadmap that is going to break down each of the specific remediation items into actionable tasks assigned to specific individuals with due dates. And I think this is really critical as you think about the size of a material weakness, like if it is an aggregation of multiple control deficiencies, or it is the result of a very significant failure or breakdown in systems or IT controls, things like that. There may be multiple elements that go into the remediation. And so making sure that everyone understands kind of the key timelines and the tasks that they're responsible for will be really, really important. So again, just making sure that you are doing this as soon as possible. I think your best opportunity to remediate is when you take early action. So when you consider the key activities and the required sequence of events, that's what's really going to drive that timeline. So for example, if you've got to update your control activities, you'll need to do that first. Then you'll have to train your control performers on how to do or what those changes are and how to execute the controls. Then those control performers are going to have to execute the controls. Oftentimes those controls are only performed monthly or quarterly, so it's not like you can just do it one day and, oh, it didn't quite work, we're going to do it again tomorrow. It doesn't always work in this process. So you do need to understand kind of the sequence of all the events that need to take place, and then consider that like when you can actually execute the control. In my experience, when you do have a significant material weakness, there's also a lot of hand-holding. Training is super important, just making sure that people understand what they need to do and why they need to do it, as well as the evidence that's going to be required to demonstrate the execution of the control and satisfy the requirements of those who are making the final conclusions, generally your external auditors. This is something that's really important, I would say, training specifically with IT. I've worked with a lot of companies that have material weaknesses related to IT, and IT oftentimes include personnel who haven't worked in public companies or don't have an understanding of that SEC regulatory environment. And so they don't necessarily understand their role and the impact their role has on SEC reporting. So it's really important to make sure that they understand that. And I think it also just helps get buy-in and ownership. So this table represents just the kind of the generally accepted sample sizes required by external audit firms. And so I wanted to share it because I think it's important that when you're putting together that plan, that you understand how many samples are also going to be required in order to remediate. So when I work with clients to remediate a material weakness, we're always trying to make sure that we've got multiple opportunities to execute and then re-perform those controls in case you have failures in that first instance. So, if you have a new quarterly control that's been designed to remediate a material weakness, it's really great if you can do that early in the year, say in Q1, so you have a Q1 or Q2 sample to assess the design of that new control. And then that way, if you have a problem, you do have time to remediate and then re-perform it again for another 2 or potentially 3 quarters, giving yourself time to remediate by year end. So. And then your 10K, like I mentioned, will likely highlight a high-level plan that you can leverage when you prepare that detailed remediation plan. So just keep in mind that these disclosures have probably already been reviewed by several parties, including your external auditors, and it is a good framework for making or developing that detailed remediation plan. And just kind of a pro tip, we like to tell our clients to be as specific and clear as possible when they're drafting material weakness language for their SEC filings. When you have a more clearly worded material weakness, it's much easier to remediate than a vaguely worded material weakness. So we would suggest saying things very clearly, such as failure to properly account for lower of cost or net realizable value, versus saying we have deficiencies in inventory. And then the last item in just kind of developing that plan, and certainly not the least important, is to just make sure you've identified all of the relevant personnel to include in that remediation effort. You really want to have a cross-functional team, especially if you have a very broad material weakness, but you'll want to include folks from accounting, internal audit, IT, operations when necessary. Each of these departments is going to provide a pretty unique expertise and perspective that will contribute to having a comprehensive understanding of the root cause, the issue, and the solution. And then I'll also say that internal audit is actually quite a critical role in supporting both the design and education elements in the remediation of the material weakness. I think sometimes people overlook the fact that they actually have a full understanding of the end-to-end process and the risks and controls that exist within that process that maybe an individual within a department may not have because they're more siloed to their department. We've got our next polling question here, Emily.
All right, our final polling question: who should be included in the cross-functional team to remediate a material weakness? And your options are A, accounting and finance, B, internal audit, C, IT, or D, all of the above. We'll give everyone a few seconds here on this final poll. Once you have completed all CPE requirements, you'll be able to download a PDF of your CPE certificate from the CPE progress window. few more seconds while we get these last responses in.
This is a softball. You should get it right.
All right, let's go ahead and see what everyone has to say. Back to you.
All right, we got a lot of smart people in the room. That's right. I think, again, just highlighting, you really should be including a cross-functional team with folks from all over the organization. So I'm going to keep cruising because we are coming up on the end of our session. So just kind of continuing on this, now that you have a plan, I think it's also extremely important to make sure you have a collaborative approach and one that is aligned with your external auditors. I think alignment with the external auditors is going to help streamline that remediation process. It's going to make sure that you both agree on the root cause and the proposed resolution. One thing that we mentioned earlier when we were talking about the trends is that often internal control deficiencies can be the result of an internal control failure or as the result of accounting deficiencies. And I think when it's an issue that's directly related to the financial statement audit, making sure that you have clarity around that and alignment with your external auditor is going to be really important. You also just want to have buy-in from them on the remediation plan, because ultimately the external auditor is the one that's going to be concluding in their attestation. So while they can't necessarily advise on a solution, they can provide insights, they can share what they're seeing in the industry, and share kind of what their firm's remediation requirements are going to be. As you execute the plan, you'll want to make sure that you continue to monitor the execution of the plan, track your timelines, and really just be nimble and available to address changes quickly and deal with any delays quickly. So I think just monitoring is very important. And then conduct internal assessments. And after the remediation plan has been executed, the controls have been executed, like I said, you'll want to do those internal assessments as soon as possible so that you can make your own conclusion and determine if you need to adjust. If you're implementing automated controls, I would test them before the system goes live so you know it's going to be successful. For manual controls, test them as soon as they become available. The sooner you get eyes on these things, the better. So then I've got a quick summary here. We have a couple minutes left for questions, but I think really I'll just highlight that I think it's so important to have a plan. If you're kind of just shooting from the hip, it is going to make it challenging. And I think, investors and management and those charged with governance are really going to want to make sure that there's a good plan and progress being reported. So just remembering that it takes time to remediate. So be diligent, be patient, and it'll all work out. Thank you very much.
All right. Well, thank you so much, Erin. As part of this, as we wrap today's session, if you have any questions, go ahead and put those in the chat. I've been responding. Unfortunately, it's me and not actually real, AI or something like that. So it is, unfortunately, you get stuck with me. I have been responding to that. We've got a lot of great questions in the chat that folks have mentioned. So again, as you go through this, one, thank you for attending. Two, we'd love to help support you in this. We spend a lot of time helping companies think through these things, either ideally preventing them up front, or helping them to remediate and respond to these things, including working through with their auditors what that looks like. So from that perspective, feel free to continue to put questions in the chat. We can respond back there. What I'll do now is we're just about at the top of the hour. I will flip this back to Emily. She'll give you some information on CPE. I know that's why a number of you are here. And then from there, we'll wrap today up. But again, if you have any questions, you want to reach out, our contact information is available here. Obviously, these materials will be sent out to you, so please reach out to Erin or I. We'd love to help, and we've got a team nationwide that can help support you, both here across the United States and then also abroad. I know see a couple folks talking about foreign filer 20F, 40F. So again, we've got teams around the world that can help with you. Emily, over to you.
All right. Thank you so much, Findley and Erin, for a great presentation today. As Findley mentioned, if we didn't have time to answer your questions, we'll do our best to follow up with you after the webcast, or you may reach out directly to Findley or Erin via their contact info here on the screen. And as a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 3 weeks should you have any difficulty downloading it now. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Please also visit mossadams.com for future webcasts and other resources to help elevate your performance upward. Thank you for joining us, and we hope you'll join us again next time.